There's a number that can destroy your financial future, and most Americans holding precious metals have never heard of it. That number is 28. Not $28,000, not 28 million, just 28. It's a percentage, and it represents the federal government's cut of every gold bar, every silver coin, and every bullion round you sell, regardless of how long you've held it, regardless of inflation, regardless of whether you've actually gained any real purchasing power at all. The stock market investor pays 15, maybe 20% on long-term gains. You, the person who bought gold because you didn't trust the system, pay 28. And that's before your state takes its slice. But here's where it gets darker. That 28% assumes you did everything right. It assumes you kept receipts from 2 decades ago. It assumes you understood the difference between coins that trigger federal reports and coins that don't. It assumes you never accidentally committed a felony by selling your silver in the wrong pattern. Because in America, the way you sell your gold can send you to prison. Even if the money was legally earned, even if you paid every tax you owed, even if you had no idea you were breaking the law. Right now, in 2026, the IRS has more agents, more artificial intelligence, and more cross-referencing capabilities than at any point in American history. They're not hunting billionaires with armies of attorneys. They're hunting the quietly wealthy, the retiree with 100,000 in gold coins, the small business owner who inherited her father's silver collection, the careful saver who thought precious metals meant privacy. These are the people losing their life savings to audits they never saw coming. This is the gold trap, and the government built it over 90 years ago. They've just been waiting for technology to catch up. The question isn't whether precious metals are a good investment. The question is whether you can actually access your wealth when you need it, or whether the exit ramp has been rigged with tripwires you can't see. To understand how deep this goes, we need to look at a piece of legislation most Americans have never heard of. It was written in an era of gangsters and bank runs, and it's being weaponized today against ordinary citizens trying to protect their families from a devaluing dollar. The Bank Secrecy Act was signed into law in 1970, ostensibly to catch money launderers and organized crime. At its core sits a deceptively simple requirement. Any business receiving more than $10,000 in cash must file a federal form. That form, known as the 8300, captures your name, your address, your social security number, and the nature of the transaction. It goes directly to FinCEN, the Financial Crimes Enforcement Network, where it sits in a database alongside reports on suspected terrorists and drug cartels. For decades, this law was a background hum in American commerce. Then gold started climbing. A modest stack of 50 coins that might have been worth $30,000 in 2010 is now worth well over $125,000. Suddenly, ordinary Americans are walking into coin shops with transactions that would have been unremarkable a generation ago, and they're triggering federal surveillance systems designed to catch criminals. The $10,000 threshold isn't just about single sales. The law captures what it calls related transactions, and the definition is deliberately vague. If you sell $8,000 in gold on Monday and $7,000 on Tuesday, you haven't outsmarted the system. You've committed structuring, a federal felony that allows the government to seize every penny, even if you earned it legally, even if you paid your taxes, even if you simply didn't know the rules. The intent to avoid a report is itself the crime. Ignorance isn't a defense. It's an invitation to lose everything. But the cash reporting is only the first layer. The IRS has a separate weapon called the 1099-B, and this is where the complexity becomes genuinely treacherous. Certain precious metals trigger mandatory broker reports. Others don't. The distinction has nothing to do with value and everything to do with a bureaucratic list created in the 1980s. If you sell 25 ounces of Canadian maple leafs, the dealer becomes a federal informant by law. Your social security number goes straight to the IRS. But if you sell the exact same dollar value in American gold eagles, that reporting requirement vanishes. The eagles weren't on the original commodity list because they didn't exist when the list was written. If you are starting to see how arbitrary this system is, how it punishes the uninformed while rewarding those who know the loopholes, you are understanding why this matters. Hit that subscribe button and stay with me, because we're about to go deeper into the mechanisms that separate the people who keep their wealth from those who lose it to paperwork. The high net worth community has exploited this eagle exemption for years, moving millions in unreported transactions, while average investors get buried in compliance. But here's what the wealthy understand that most people don't. The exemption only covers the dealer's reporting obligation. You still owe the tax. You still must report the sale on your own return. The difference is that without the 1099-B, there's no automatic flag, no immediate cross-reference telling the IRS to look closer at your finances. For the sophisticated investor, this is privacy. For the uninformed investor who thinks no report means no tax, this is the beginning of a nightmare. And then in 2024, something shifted that would accelerate everything. The IRS didn't just get more funding. It got artificial intelligence capable of scanning every bank deposit in America for patterns of inconsistency. A school teacher earning $60,000 a year who suddenly deposits $40,000 in cash from a private silver sale doesn't slip through the cracks anymore. The bank's software generates a suspicious activity report. And unlike the 8300, you're never told when one is filed. It simply sits in a federal database waiting for an algorithm to connect dots you didn't know existed. What the public sees is a tax code. What actually exists is a surveillance architecture. The IRS has data sharing agreements with luxury retailers, real estate title companies, and even private jet brokers. If you use unreported gold proceeds to buy a $400,000 vacation home or a high-end vehicle, the acquisition creates a beacon. Your reported income says one thing, your lifestyle says another. That discrepancy triggers what investigators call a lifestyle audit. And once you're in that system, every financial decision you've made for years becomes subject to scrutiny. The government also wields something called a John Doe summons, which allows the IRS to demand customer records from any gold dealer or vaulting company without naming specific targets. They simply request everyone who conducted transactions above a certain threshold during a specific period. If you thought storing $1 million in a private, non-bank vault made you invisible, you're wrong. One court order can hand your name directly to auditors, who will cross-reference your holdings against your tax returns. A client with $2 million in gold who reports $60,000 in income becomes an immediate priority. They'll examine credit card statements, travel records, and social media posts to prove your metal is funding a visible life of luxury you haven't explained. The penalty structure is designed to terrify. Willful failure to file carries fines up to $25,000 in a year in federal prison. If the IRS determines fraud, the penalty explodes to 75% of the underpayment. On a $100,000 transaction, that's not a slap on the wrist. It's financial annihilation. And through civil asset forfeiture, the government can seize property it merely suspects is connected to a crime, even if you're never charged. You then spend years and tens of thousands in legal fees trying to recover what was always legitimately yours. This brings us to the deepest problem: cost basis. If you cannot prove what you originally paid for your gold, perhaps because you bought it decades ago or inherited it without documentation, the IRS can legally claim your basis is zero. They tax the entire sale amount, not just the profit. On a $600,000 sale of gold you purchased for $100,000 20 years ago, losing that receipt doesn't just cost you the accurate tax calculation. It costs you an additional $28,000 in unnecessary taxes. One missing piece of paper, $28,000 gone, and if you think that's the full picture, you're not even close. Here's the mechanism nobody talks about: the inflation tax. When the dollar loses 5% of its purchasing power, your gold rises in nominal value to compensate. You haven't actually gained anything. You've simply maintained your position against a depreciating currency. But when you sell, the IRS taxes that nominal increase at 28%. You're being penalized for preserving your wealth. This is perhaps the most elegant wealth transfer ever designed, from prudent savers who distrust the monetary system directly into the federal treasury, all while appearing to be a simple capital gains tax. The numbers become staggering at scale. Selling $500,000 in gold that you have held for years means $140,000 goes to the federal government, $40,000 more than you would pay on an equivalent stock portfolio. In high-tax states like California or New York, your total exit fee approaches 40%. That $500,000 nest egg becomes $300,000 after everyone takes their cut. This is why we're witnessing a quiet migration of wealthy Americans to Texas, Florida, and Nevada before they liquidate large positions. Moving your physical residence before the sale can represent a $100,000 decision. The self-directed IRA trap catches people who think they've found a solution. Holding physical gold in a tax-advantaged retirement account sounds brilliant. And it is, until you make one critical mistake. If you take physical possession of that gold, even temporarily, the IRS treats it as a deemed distribution. On a $1 million IRA, that triggers an immediate tax bill of roughly $370,000 plus a $100,000 penalty if you're under 59.5. Nearly half your fortune vanishes because you wanted to hold what you thought you owned. So here's the question that should keep you up at night. If every exit is taxed at 28% or higher, if every large transaction triggers federal surveillance, if every mistake can result in seizure, what exactly is the point of owning gold? The government has engineered a system where entering the precious metals market is easy, but leaving is extraordinarily expensive. They want you in stocks and bonds, where every penny is tracked in real time, where there's no possibility of privacy, where the tax infrastructure is seamless and automatic. Gold represents an escape hatch from that system, and the 28% collectibles tax is the price they've set for using it. Think about that for a moment. Is this really about fair taxation, or is it about discouraging financial independence? Drop your perspective in the comments. I genuinely want to know where you land on this, because the implications go far beyond precious metals. The inheritance strategy reveals who truly understands this game. If you hold gold until death, your heirs receive what's called a step-up in basis. That means their cost basis becomes the market value on the day you died, not what you originally paid. A $500,000 collection you bought for 50,000 passes to your children with zero embedded gain. But if you gift that same collection while alive, they inherit your original basis. And when they sell, they owe 28% on $450,000 of gains. That's a $126,000 difference based purely on timing. This isn't about hiding wealth. It's about understanding a system designed to capture it. The architecture we've examined wasn't built overnight. It evolved across 9 decades, from Depression-era banking laws to post-9/11 surveillance expansions to the AI-powered enforcement capabilities of 2026. Each layer was added with reasonable justification, catching criminals, preventing money laundering, ensuring tax compliance. But the cumulative effect is a system where ordinary Americans holding $100,000 in precious metals face the same scrutiny apparatus designed for international drug cartels. The path forward requires treating your precious metals like what they actually are under the law, a heavily regulated asset class with unique reporting requirements and punitive tax treatment. This means maintaining meticulous documentation from the moment of purchase. Every receipt, every assay certificate, every 1099-B received goes into a permanent file. When auditors arrive, and for anyone with significant holdings, this is increasingly a matter of when, not if. The ability to demonstrate a clear chain of custody and taxes paid is the difference between a routine review and financial devastation. It means understanding which coins trigger reports and which don't, then making purchase decisions accordingly. American Gold Eagles offer reporting advantages that Canadian Maple Leafs don't. Pre-1965 silver coins have different thresholds than pure silver rounds. These aren't secrets, they're published IRS guidelines, but the government has no incentive to educate you about the options that provide more privacy. It means recognizing that the $10,000 cash threshold is a tripwire, not a target. Structuring transactions to stay below it is a federal crime. The only legal approach is either staying genuinely below the threshold in unrelated transactions, or accepting the reporting and ensuring your taxes are properly filed. There is no clever middle path that doesn't risk prison, and it means considering the exit strategy before you need it. Liquidating a large position in a single year can push you into higher tax brackets and trigger additional levies like the net investment income tax. Spreading sales across multiple years, timing them around other income events, and potentially relocating to a more favorable state jurisdiction before selling, these are decisions that can represent tens of thousands of dollars in legitimate savings. The government wants you to believe that gold ownership is antiquated, that digital assets and traditional securities are simpler and safer. In terms of tax treatment, they're right. But that simplicity comes with total transparency. Every transaction visible, every holding known, every gain automatically reported. For those who value the option of financial privacy, who want assets that exist outside the banking system, who believe that diversification should include something the government can't digitally freeze, precious metals remain compelling despite the obstacles. The trap is real. The 28% tax is real. The surveillance infrastructure is real. But so is the inflation eroding your purchasing power. So is the national debt demanding ever more revenue. So is the possibility of financial disruption that makes physical assets valuable precisely because they're difficult to seize remotely. The question isn't whether gold is perfect. Nothing is. The question is whether you understand the rules well enough to navigate them. Or whether you're walking blind through a minefield designed by people who don't want you to reach the other side. The empire of financial surveillance isn't crumbling, it's expanding. Your only defense is knowledge, knowing what triggers reports, what triggers audits, what triggers seizure, and what triggers prison. The people who built this system spent decades refining it. You have the length of this video to start understanding it. The gold trap is wide open, and now you can see exactly where the edges are. What you do with that knowledge is up to you.